was a pretty decent day if you look at where some of the gains were had. Energy, obviously a big loser, though.
Yeah, a lot going on below the surface, though. I do think the broader message of this market is that it just kind of holds here near the highs. We first got above 3,000 in the S&P 1 week ago and have more or less hovered in that area with a little bit of a shot above it the other day. So I don't think that there's been a lot of drama in terms of the overall market positioning. Market is fine with bond yields going up and then backsliding a little bit. I don't think you want to see a real acceleration lower in bond yields from here. See how they react to the Fed tomorrow. But overall, I do think that we're kind of getting ourselves into this neutral position near the highs right in time for another Fed decision. As Dan's been mentioning, as I've talked about a couple times, that was an occasion for the start of a pullback in both May and July. But I wonder if now that we're all fixated on that, it's not going to happen.
Danny, we saw rates rise as the market recovered over the last couple of weeks. Does the Fed now derail that if they cut rates tomorrow or not?
I don't necessarily think so. I mean, the thing that's just baffling is that we're at all-time highs, and the Fed is going to cut 1/4 of a point to kind of encourage more borrowing. And really, it's got to be demand-driven, I think, if we're going to really see the next leg up dramatically. But I think that they're in between a rock and a hard place. And, there's been a huge deluge of buyers of bonds in the United States because of what's going on globally. And so that's why they've got to cut.
What is the correlation right now between oil and the stock market, Dan?
Well, I think in the last 48 hours, we've seen that when oil was down a lot, it was more a function of, when it was up a lot, equities were down. Now that it's down today, we're seeing equities kind of bounce a little bit. So it's kind of negatively correlated here. And that makes some sense. But as we talked about in the last hour, we don't think energy stocks are not a big mover within the S&P 500. I want to make one point about what Mike said. With the S&P back at 3,000, if you go back to January in 2018, every time we've been above 2,900, we made a new incremental high from the prior high. It has been an impetus for sellers to come in. And we've had some pretty significant sell-offs. Q4, we had a 20% peak to trough decline. We've had a 7.5% peak to trough decline this year already. So, to me, I don't really see what the impetus is on a rate cut to buy stocks if you're still not that optimistic about global growth and you're not optimistic about earnings power accelerating because of that cut.
Mike, sorry, I was just going to say the issue is where else do you go? I mean, from a global perspective, where else do you put your money where you're going to get some kind of return? With so many large issuers yielding very well, people are going to the stock market rather than the bond market. So it's
no, and my point is really simple. Don't buy them at 3,000. Buy them on the pullbacks, because where are you getting the alpha? You're getting them when we pull back. And we've gotten 4 really consistent pullbacks from these levels over the last 19 months or so. I just don't see what the impetus is to make a meaningfully new range above 3,000. We just haven't been able to do it so far.
But, Mike, we're quite well supported at this level, it seems like, when you look at volatility.
I think the weight of the evidence says you are pretty well supported. Now, you have to go back to December and you look at the dynamics around that low. If you basically have a premise that was a very consequential low in terms of the carnage that came before it, in terms of the volume of buying around that low point, then what it means is it buys you a little bit of the benefit of the doubt now when you've had these subsequent pullbacks. Nothing says you can't go down a few percent for here on almost nothing. But to me, being sideways for a year and a half with a slight upward tilt and having the macro starting to inflect a little bit to the better in terms of the data flow right now, I think that things like yields, oil prices, and sentiment are all in a zone where the market has a little bit of a buffer.
I mean, we're waiting. FedEx looks like a miss at first blush. We'll get to the numbers as soon as we dig through them. But how much of a sentiment gauge is that?
I think FedEx has been an unusual situation where people were thinking they were already braced for a miss, thinking that expectations were already low, and the numbers have continued to come out and not actually proven that to be the case.
Yeah, it's not pretty.
But the stock has been up a tremendous amount in a month. Right, so it's had one of these things where it's down by 33% of 12 months, but it's up a lot this month.